What I have for you today is the OECD Forum on Tax Administration Manual on the handling of multilateral mutual agreement procedures and multilateral APAs. This came out in early 2023, and it is guidance only, right? It says in its introduction, this manual is intended as a guide to multilateral MAP and APA processes from both legal and procedural perspectives without imposing a set of binding rules. So let us see what it says. It's broken into 5 parts. First is a short introduction. Then it talks about what is the legal basis for dealing with multilateral maps and APAs. What is the procedures? What kind of steps do you need to do? It gives some examples, and then it ends up with timelines, proposed timelines for how long these things should take. Here you get a brief overview of the different sub-chapters, and you can see the basis for handling talks about what the definition of a multilateral case is, the legal basis for it being 25(1), 2, and 3, how multilateral case requests should look and under which articles they should be filed, and then saying that they also Action 14 is applicable. And the procedural aspects pretty much deals with how these things should be done, and most of the bilateral MAP rules apply throughout. And then we get to examples and the timelines. The detail of all of this is discussed in my course. Here I will go straight to the examples. A 10-second commercial. If you want to learn more about international taxation or transfer pricing, or treat yourself to an all-round update, or if you want your team to learn or stay updated, please visit my online courses. So they give examples of transfer pricing cases, PEs, hybrid entities, and dual resident entities of where you might need a multilateral MAP or APA. And the first example concerns transfer pricing. So you've got company A selling semi-finished goods to company B, and then company B sells finished goods to company C, which then distributes to third parties, right? And now the issue here is that company C does not have an arm's length result, but company B does. So apparently company A must be a principal. And then the question here obviously is you cannot adjust the BC result because then B is not at arm's length anymore, and therefore it is better for A, B, and C to all get together in a multilateral MAP or APA. In the second example, transfer pricing, you can see here you've got a principal company and it sells to company B, which is a regional distributor, and then company B sells to C, D, and E, which are local distributors. And the issue here is that the group as a whole is loss-making, but the countries C, D, and E says, yeah, but hang on, we've got limited risk distributors here, so we should not be making losses. Now, obviously, they can't bilaterally make adjustments with company B if company B is already making an arm's length income, so therefore you need A, B, C, D, and E all together in a multilateral MAP or APA. And then we get to PEs. I don't find this an ideal example, but it's fine. We've got company A, which then lends money or borrows money from PE, which belongs to company C, and then company A pays interest to the PE, well, which is subject to 10% withholding tax under the AC treaty. Remember, the PE is not a resident, so you need to look at the AC treaty. And now the question is, the income of PE is taxed in country B, not in country C, especially not if there's an exemption system. Will country B give relief for the 10% withholding tax? Now you've got the problem with the AB treaty that is not applicable because PE is not a resident in most PE cases. But under Article 24.3, which deals with non-discrimination, one should say that if a normal company's resident in country B would have gotten a tax credit for the interest withholding tax from country A, then under the BC Treaty, Article 24.3, the PE should be entitled to a similar tax credit. And maybe that can be solved through a multilateral MAP or API. I quite frankly think this is more of a BC problem than an ABC problem, but that's not what the guidance say. And they also refer to this case basically being discussed in Article 24, paragraph 67 through 672. And then we get to a more realistic issue, I think, and that is if you've got company A, which has PEs in jurisdiction B and in jurisdiction C, and the PE1 makes transactions with PE2, and PE2 makes an adjustment to the transaction between PE1 and PE2. Now, neither of these are residents, so the BC treaty wouldn't apply, and company A might give double tax relief for this one, but it does not have to give any double tax relief for this one if this one doesn't make a corresponding adjustment. And then all three countries need to get together to solve this either through a multilateral map. And the commentary referred to here is paragraph 38, 1 through 4, again describing a similar situation, and paragraph 50, which then specifically deals with the issue at hand here. And then we get to a hybrid example, quite complex, but therefore also fun to look at. You've got jurisdiction A, you've got three individuals there in a partnership which is in jurisdiction B. A sees the partnership as transparent and B sees the partnership as opaque, and then the partnership earns income from jurisdiction C. Now, just to take jurisdiction A, for A's point of view, they do not see the partnership, so the income comes directly from C and it is business income from a PE. From B's point of view, this is a company, not a transparent entity, and therefore the PE receives income from the company receives income from the PE in jurisdiction C. And now I think the issue here is you might be able to get away with no double tax. I'm not saying you get away with no tax, but I don't think you will run into double tax. But the situation is complex, and therefore it might help to especially have a multilateral APA, I guess, here, because if we look at Article 1.2, remember that deals with hybrid entities. Now, if we apply 1.2 under the AB treaty, right? So country A to country B, this is the transparent and or the hybrid entity, right? So for purposes of the AB convention, income derived by an entity, the partnership, that is treated as fiscally transparent under the tax laws of B or A shall be considered to be income of a resident of B, right? But only to the extent that that income is treated for purposes of taxation by B as income of a resident of B, and B will tax the partnership. So I think we're okay here, right? And then A should give some kind of dividend tax relief or something like that, right? But I think the condition of being taxed in B is fulfilled here. If we look at C, things get a little more complicated because it depends on whether C sees the partnership as transparent or as opaque. If C sees the partnership as opaque, just like B does, then under the BC treaty, B will give relief for the PE income because there is no application of Article 1.2, right? The issue becomes more what happens under the AC treaty. I mean, if we read the text of Article 1.2 again, for the purpose of the AC Convention, income derived by an entity that is treated as fiscally transparent under the tax law of A or C, so it's treated as transparent under the laws of A and as taxable under the laws of C, shall be considered to be income of a resident of A, but only to the extent that the income is treated for purposes of taxation of A as income of a resident by A. And then this time you can't really deal with B because B is not under this treaty, right? So now you have to say that, okay, then A must give relief for whatever tax there is under the from the partnership, and so you do not end up in double tax from my point of view. If someone else thinks different, please make a comment below. And then we look at C's partnership and B as transparent. So now it follows A's point of view. Under the AC treaty, A will give relief, right? And there's no application of 1.2 under the treaty because A now says I've got a PE in C and I will give double tax relief for the tax in C, and C says you've got a PE in C and your partners are in A. There's nothing in B, and things are okay. Under the BC treaty, however, things are a little different because remember, B still taxes the jurisdiction, right? But under the BC Treaty, for the purpose of the BC Convention, income derived by an entity that is treated as fiscal transparent under the tax law of B or C shall be considered to be a resident of B, as it should, but only to the extent that the income is treated for purposes of taxation by B as the income of a resident of B. And again, I mean, it is, B is taxing the partnership, so it will give double tax relief for the tax paid by the PE in C. I think you are okay. And then finally, under the AC Treaty, if one even gets there, one would have to say, for purposes of the convention, income derived by the entity that is resident as fiscally transparent under the laws of AOC shall be considered to be income of a resident, but only to the extent of A, but only to the extent the income is treated for purposes of taxation of A as income of a resident of A. And now you get to this situation where B is completely ignored and everything, and you can see it's a repetition basically of what we have under the second sub-bullet. So things work out okay. And then finally, we've got dual resident companies, and here we've got company A. It is incorporated in jurisdiction A, so it's treated as a resident there. It is strategically managed in jurisdiction B, so it is treated as a resident there. And now you've got Article 4.3 of the treaty, which says, in case of a dual resident company, the company doesn't have any treaty benefits until the competent authorities have decided where it's resident. But 4.3 doesn't cover a three-country situation. Now you can make this a bilateral three-country, three bilateral treaty situation, but you could also use a multilateral APA or map here, because in jurisdiction C, let's say the operational center or the daily management is in C, and one would assume that for jurisdiction C that means that company A is resident in A. What I find interesting as an example, and then all dual resident company examples, is of course that I'm not sure what the difference is between a dual resident company and a company resident in one state with a management PE in the other. From when the switch over goes from management PE to resident because of place of effective management or operational center, I am not sure. And then finally, this is just the overview of all the different chapters that we cover. Now we come to timelines, and there's timelines for maps and APAs, and it basically follows what is done under Action 14. And for the multilateral map cases, it says, you receive the map request, and within 4 weeks you need to let the other competent authorities know that you have one. You should let the taxpayer know whether you think it is admissible within 2 months, and then you should decide whether the objection is justified and whether unilateral solution is possible within 3 months. If you don't, then everyone must everyone must decide who will make the first position paper. Typically that will be the country that has made the adjustment, right? And then they need to submit the first submission paper within 12 months. And then if they do it after 8 months, then the response paper must be 6 months later, with the 14 months. If they do it after 12 months, and within 12 months, then obviously the response papers need to be due within 6 months, and then you exchange position papers before you have a meeting, and that must be at least 2 to 4 weeks before you have a meeting. And the mutual agreement procedure must not be done within 2 years, as is normal on bilateral maps, but the mutual agreement procedure must be concluded within 3 years. So that is a difference with bilateral maps. And then you must sign the mutual agreement as quickly as possible while everyone is still agreeing on what they've agreed, exchange closing letters and implement the agreement. And the taxpayer's approval must also obviously be gotten, and must be gotten as quickly as possible. And then if you look at the multilateral APA cases, it's basically the same, except of course that you don't have arbitration here. And the taxpayer must approve the meeting as quickly as possible. You get an exchange of closing letters as quickly as possible. You need the taxpayer needs to do what it needs to do to make the APA binding, and then the tax authorities must go and do what they can do as quickly as possible. I hope you enjoyed this. It's quite a long paper. One thinks that multilateral APAs and maps should not throw up a whole lot of issues, but clearly they do. I look forward to seeing you next time. Bye for now.